The battle between stocks and gold is never ending. Here to settle this debate today is Michael Danov, CIO and President of SBP Management. Michael, it's a pleasure to speak with you again. Welcome back to the show.
Thank you, Dave, for having me.
Before we get started, Michael, why don't you tell the viewers a little bit about your fund, what you're primarily invested in right now, the sectors you're looking at, and what your thesis is for your investments.
Sure. We are a single family office here based in New York. Our core focuses are among three industries. Majority where we focus is natural resources. It's kind of our expertise and background. That's something I've covered for the last 10 years. We diversified, I would say, to biotech, healthcare, and as well consumer goods in the last few years as well. Our thesis as of today, what we've seen is opportunities where we could get value growth. Majority we've been looking again in the mining space for the last, I would say, 2 years actively, specifically in the gold and silver space. And we're looking for value position, again, stocks that have the growth, the momentum, well-positioned cash flow, and we see how that could pan out for our portfolio in the next couple of years.
The recession that we've seen that was sparked by COVID has presented an opportunity for tech stocks to really outperform and shine. A lot of tech companies have positioned themselves as being indispensable services in today's society. What other opportunities do you see coming out of this, do you think?
I think outside of the tech space, we would see untraditional sort of the nuts and bolts businesses that traditionally have done over the years and been undervalued and been overshadowed by the tech companies. Additionally, I think the resource space, specifically metals and mining, we had a nice run in the last few months as well with the surge of the gold. But I think in the long term, the tech companies will eventually divest it out, as a lot of the investors are looking for short-term momentum right now. And we will see a reverge back into the traditional investments, whether it's the banks, whether it's the insurance companies, of course, hopefully the real estate REITs, etc. But I think there's a lot of opportunity right now in those companies. It's just what is your willing to sit on it and how long versus making a return on a high-flying tech stock today.
Okay, so let's talk about the gold sector now. You obviously like the sector. What do you like most about it? Is the fact that the bullion itself has had a nice run up, is supporting a nice base for the stocks, or are there good fundamentals behind the mining companies that you're looking for as well?
Sure. So I've started paying attention a bit more last 2 years, actively looking for companies that were undervalued because the gold price was not giving them enough return in their portfolio company internally in terms of the operations. There's a few companies that we invested that have done extremely well, and over the cycle, let's say 12, 16 months, they finally got the true value because they started delivering free cash flow. And I think institutional investors started to pay attention to those names and slowly but surely coming in. But overall, the industry still has, I think, more room to grow, especially as we see the next 2 to 4 quarters as more free cash flow comes in the balance sheet of the producers. And I think that we'll have a nice uptick in the companies going forward. So I don't think it's the end. It's just the beginning for some of these companies to tap into.
You were on Kitco last year in 2019, and back then you had said that the mining industry is facing, or was facing many major challenges and major headwinds. Do you think those challenges and headwinds are still in place today, or are things looking better?
For certain industry companies, I think it has changed. I think companies are being more cautious today with that uptake of the gold price and managing their expectations carefully. Nobody's going after multi-billion-dollar projects, whether it's exploration side or trying to expand their current. They're being more cautious, and the industry, I think, is getting smallly rewarded by them being extra cautious how they're managing their day-to-day expectations of the growth of their companies. So I think there are still some challenges in the remote specific companies areas where they were still undershadowed, but in the long run, I think at one point they might get more attention.
All right, so both gold and stocks have hit all-time highs this year, which is very interesting when you think about it. Which asset class do you think has more room to climb, and which do you think will outperform?
As much as I want gold to perform more, but I think just the larger side of the stock market where we are trading today, I mean, if you look at the 5-6 top tech companies, they just surpassed the whole market cap size of the whole European stock exchange, which is fascinating how much capital has been just going to one specific industry on a large names and with few of the names. I think the equity market will grow. But again, I just don't think the specific one industry within the equity market that will outperform for long term. And I would appreciate that some more of those investors who made that return on their tech stock or anything related to the industry would eventually come back to the natural resources. But I think it's still a lot of long-term education for them to understand how the natural resource market works, especially the downturn we had in the oil and gas space.
And stocks are going up mainly because of improving economic factors, or do you think the Federal Reserve is going to be injecting more stimulus? Why is it going to go up, Michael?
So there's a couple of combinations why it's been going up and how it's going to go going up. I think that with the traditional Fed and stimulus buying the ETFs and traditional pumping the money to the U.S. economy, and the rest of the world is still in the recovery phase in terms of other exchanges and other markets, and a lot of the non-traditional investors are just following the pattern in a sense of what the government is doing, and I don't think that's sustainable because sooner or later the government will stop funding the equity ETF markets and then buying more, and then the question is what happens then. Will these traditional follow investors will come out, and how will the market react to that? So that's something they're determined to see, and I think it's just going to be a matter of time that's going to stop. And I think in addition with the U.S. elections, I think post the election we should see some change, and I think it should correct itself to some degree.
Okay, let's say an investor were to start investing today from scratch, building a portfolio from scratch. How would you advise him to allocate his assets? Would he be more defensive? Would he be more heavily invested in the cyclicals? What's the split between equities, fixed income, and gold?
Sure. I would advise if somebody wants to start investing today, I would break it up in three categories, major categories. I would go on the traditional institutional names where you could get a smaller return, but the safe bet would allocate 30%, whether it's the insurance companies, whether it's the traditional banks, and etc. I think the second would be getting a little bit exposure to the natural resource, specifically in the bullion space, whether you buy the ETFs or the direct large producers, which is few of them that could give you a nice portfolio diversification. And maybe in the additional 20% go in traditional fixed bonds income returns, annuity sort of type return REITs. And then the rest of the portfolio go a little bit on the riskier side where you could allocate to something opportunistic, and it'll be volatile, but it will give you a greater return over the time. And I think your portfolio will be managed well done. It all depends what you start in terms of your capital, but I think that'd be a good start for any brand new investor.
And what's your view on the U.S. dollar?
The U.S. dollar has been interesting last few years and how it's performed and how it's looked. I think that the U.S. dollar will stay strong because one major factor, the rest of the foreign currencies are not performing. Whether it's the China-U.S. trade deal, whether it's the European economic crisis all over, where the euro has been unstable, with a lot of the countries even want to leave the eurozone and be separate. So I think a lot of the paper still, U.S. dollar paper is still valuable and still 60% of the world commodity currency. And I think that's going to be long term, and I don't think it's going to go away until we see a better improvement in other global markets.
All right, Michael, so you're bullish on the broad indices, you're bullish on natural resources, gold, and the dollar. What are you not bullish on? What do you not like right now?
As much as I want to say, I don't think the tech companies should be where they are today. I think it's unrealistic valuations what we're having. Whether it's the new ways you said the Robinhood traders are keeping the economy, or the specific names supporting these companies. I think at some point that has to be realized, and just it's trading way where they should be. And I think some of that investments that's going in there should be diversified for broader markets and broader industries overall.
So you don't think their valuations justified, even though that if you look at some of these tech companies, they're the only companies out there making money today in today's environment, where everyone else is going bankrupt or operating at part capacity. You think they're still overvalued?
I believe so. I mean, you cannot have a company like Tesla or something similar to be trading a $300 billion valuation and just hitting into profitability in the second year, coming into as a company overall, where you have traditional names, whether it's the GMs of the world, of the Toyotas, where they're more traditionally based companies and not getting the true valuation. Because again, I think a lot of these companies are still tech focused, technology, and they will be treated as a technology play versus a traditional company where it has fundamentals and growth and so on. Unless I think they could have some M&A aspect, maybe that's what a lot of the investors might be thinking down the road. But I just think organically there's where you could put more fresh capital, which companies will pay attention, like banks, for example.
Yeah. I think some traders and investors of tech stocks would look at a company and say, we're not supposed to gauge tech companies on the same valuation metrics as everyone else. They're supposed to be a little bit more expensive. And really, you're supposed to be picking tech companies based on their growth potential, not on current valuations. Would you agree with disagree with that?
I would agree with that. But I don't think anybody thinks that way, unfortunately. And everybody's just trading on a momentum investment. So I call these momentum investors versus sit on an investment for 2-3 years.
Yeah, but Michael, if the tech companies fall like you said they should, wouldn't that bring down the rest of the index?
Well, the question is, if it does fall, where is that capital going to go down to in terms of the investors diversified out, right? If they exit their positions, where is that fresh, new, profitable capital going to go towards what industries? Are they going to go back into safe and comfortable investments such as the banks or the insurance companies or maybe real estate, not at the moment during the pandemic, but where would the best return, maybe not as high risk, but a comfortable investment return on their profile will come in? And I think that should be important because, again, it should not, major companies like that should not get full valuation where they are today, and because the rest of the industries or smaller in the companies are getting hurt because not enough interest from institutionals coming in. It's the same thing what we're having in the gold space right now, right? We never had new generalist investors come in today versus traditional few funds out there that left, and that's why we don't see a growth in specifically in the market. Can the generalist names come back and improve that on top? So that's something you always should look forward to.
Do you think the tech investors leaving tech, should they leave, would go into the gold space? We're already seeing a lot more interest in gold ETFs and gold mining stocks on Robinhood this year, for example. Do you think more of that could happen?
I think a portion should be of their portfolio diversified and go to the bullion space or ETF or in the industry overall, just from a traditional diversification and not get all your eggs in one basket in a sense where everything is a high fly. At some point, that will stop it. They should be taking some profits out and diversifying into the space. 100%.
Offline, you're also telling me that you're invested in healthcare and consumer goods. Between natural resources, healthcare, and consumer goods, which do you think has the strongest growth potential right now over the next 12 months?
So the last 2 years, I focused a lot on the luxury consumer goods space and general consumer products. It's been more on the venture side of the investments where they're sort of the DTC, direct-to-consumer businesses. I see a lot of potential, especially in the high margin profile products where they are valued traditionally as a tech company as well versus where back in the day they would be valued more as a private equity business. So I see a lot of multiples being paid for those within that space, especially if their revenue kind of between 10 to 50 million, they get bought out, 5-7x on their last valuations. So that's an industry people should keep an eye on, especially if it's in the beverage space also or the food products. I think that's going to be a huge market overall. And on the healthcare side, I mean, look, obviously, we didn't touch a little bit on the pandemic side, but anything, obviously COVID related, I think there's going to be a huge market opportunity there for short-term investment, but not long-term. But the healthcare overall last 10 years has done extremely well. And I encourage people to pay attention to the space and follow certain specific names with it.
How do you feel about pharma companies?
So pharma is about 30% of our exposure as of today. So I'm pretty bullish on it. We spend a lot of time more on the early stage companies within the phase 1, phase 2, phase 3 trials industries overall within the cancer space, oncology, and etc. I think that's opportunity, and it's going to be a good M&A for larger farmers to acquire certain these assets, which has happened to us in the past. And I think that the drug industry is essentially going to grow more, and I think any more new curves we're going to have, I think that space is going to be continuing growing to the next stage.
Do you think COVID is providing a real tailwind for the pharma industry or not?
No, I think it's a momentum play again. Also, we've looked at maybe 20, 30 names who are focused on COVID. Companies usually were not even doing that well, and then all of a sudden they became a COVID play and started getting a market traction, then you get like sort of day traders to come invest in these companies. I think there'll be one or two, maybe three at most at this stage, and it's probably going to be the larger name that's going to perform, and the rest will be wiped out. So it's a short-term play.
Sure. Last question, going back to gold stocks here. Do you have a preference between juniors or seniors? And if so, can you name one or two stocks that you can share with the viewers?
Sure. I think at the moment we like more on the senior side, more on the producers or on the royalty side. So we love a good company for many years, Franco-Nevada. We like Mag Silver, we like Kirkland Gold, Endeavor Mining. So just to give you a few names that has performed well for us, these long-term plays that we support. We've been paying attention to a couple smaller junior names that I think will grow. Specifically, one of them was a spin-out from a sort of mid-tier developer right now, and I think they're going to perform well. So any assets similar to that with a good management, I think will do well. And of course, as we always say in this business, the greed is king. So that's what we've been paying attention, seeing where are the opportunities for somebody else to acquire. And the question is, at what price are they willing to pay in acquisition?
A lot of the mid-tiers and seniors are raising dividends right now. Do you see that as a positive signal?
Absolutely. I think as more free cash flow is going to come on the balance sheet, they should be raising, either if they're not doing dividends, buy back stock, anywhere to reward investors and to show credibility. It's important for them long term, especially if they want to attract new institutional or new generalist investors for them to become a stockholder.
Are you not concerned that this is eating away their free cash flow, where they at a time when production has been decreased?
At some point, yeah. I don't think obviously it has to be a majority, but they have to show some credibility. Either if they're not doing an M&A, they have to show they're doing something where it's rewarding back the investors. Because a lot of investors got burned in the last 10, I would say 7 years. And if you want us back and with our credibility, the question is, what is that going to take? And most of them have increased the dividend, but it's a sense, what can be more prudent today versus in the future.
Michael, I want to thank you so much for your time today. It's a pleasure speaking with you again.
Thank you, David. I look forward again in the future.
And thank you for watching Kitco News. We'll have more coverage for you at the Minds Money Online Connect. Stay tuned.